Almost every financial advisor will tell you to delay Social Security until you're 70, but that advice can actually cost you hundreds of thousands of dollars, because there are at least 5 situations where taking it at 62 is actually the smarter move. I'm Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's break this down. Everyone talks about break-even ages, but almost no one talks about what waiting actually does to your portfolio. If you claim at 62 versus full retirement age, your break-even point, when you will come out a winner from delaying for the bigger payments, is around age 78. If you want to delay even further to age 70, the break-even point compared to full retirement age is age 82. But waiting stresses your portfolio. Let's say a single taxpayer has $1 million saved in a traditional IRA. That and a $35,000 annual Social Security benefit are their only income sources in retirement, and they need about $80,000 a year to live on after tax. They need to withdraw roughly $92,000 from the portfolio pre-tax to meet those needs, almost 10% of their portfolio. That's not aggressive, that's dangerous. And in the short term, a down market of even 10% reduces the portfolio by nearly $200,000 after accounting for that withdrawal. Now, next year's withdrawal is an even greater percentage of the portfolio. This digs an even bigger hole. Now, compare that to taking Social Security early. Their benefits are only 85% taxable, and they would need to pull roughly $63,000 a year from their portfolio. In the scenario where the market pulls back 10%, this investor would still need a 19% return to get back to $1 million, but they have a much more sustainable path to retirement. Ideally, they invest in a way that decreases their risk even more, but as far as claiming strategies goes, this retiree can't afford to leave their retirement to just the market. Before we move on to the second reason, if you're getting value from this, make sure you hit subscribe. Most of what you hear about Social Security is oversimplified or just flat wrong. This is exactly the kind of strategy that can cost or save you hundreds of thousands of dollars over your lifetime. So if you want more breakdowns like this that actually help you make better financial decisions, subscribe to the channel. Now let's get to the second reason, and this one is even more personal. The second reason comes down to one thing: how long you actually live. Social Security is a math equation. If you don't live long enough, you'll lose. We just reviewed the break-even numbers in the last section. If you don't make it to your late 70s, delaying was a wrong decision. If you live well into your 80s, delaying will pay off in that scenario. And if you fall somewhere in between, full retirement age typically makes the most sense. This comes down to family history and your current health. One important caveat is understanding the average life expectancy of someone who is 62 years old right now. Today, this person could expect to live up to around 84 years old. This decision isn't about guessing. It's about making an informed bet based on your health, family history, and age today. So the real question isn't what's the highest benefit. It's how long do I realistically expect to cash these checks? Life expectancy is somewhat out of your control. No one gives us the exact day and time we'll no longer be here. The third reason is much more controllable and comes down to how your money is taxed in retirement. Some people can structure their income so they pay little to no taxes in retirement. And if that's you, taking your Social Security early can actually preserve that advantage. So if most of your money is in Roth accounts or tax-efficient investments, waiting might increase your taxes, not reduce them, negating any benefit you would have gotten from the larger check. You don't have to perform Roth conversions, so your Social Security benefits are not taking up room on their taxable income table. You also likely do not have a benefit large enough at this point to fill up your 0% capital gains brackets. This essentially means the only thing you have to pay taxes on in retirement is your Social Security benefit itself. For a married couple who has $50,000 in benefits, they'll pay roughly $1,000 in taxes on those benefits. If everything else is in Roth, they pay no taxes on those funds. If they have a taxable income below the 0% threshold for capital gains, they pay nothing when they realize them. This is as close to a tax-free retirement as you can get, and it allows the assets to continue to grow, creating an even larger tax-free base later on. And for those of you who have a pension, now it becomes simple. If Social Security at age 62 and your pension cover your lifestyle, there's no reason to delay. It keeps your tax from Social Security low and allows assets in the background to continue to compound and act as your inflation hedge to both your income sources, all while knowing they both will cover your living needs before you need to dip into any of the assets. Now let's switch gears a bit and talk about when one spouse in a married couple passes away. The fourth reason comes down to one thing most people miss: what happens to your Social Security when your spouse passes? Because when one spouse passes away, you lose the smaller benefit and you're left with what's called your survivor benefits. Let's go over an example. Your spouse is 67 and has current monthly benefits of $3,000 a month, but they haven't collected those yet because they haven't needed the money. You just turned 62 and your benefits are $1,800 a month should you claim. Even if you don't need the income, it still makes sense to take it. Why? Your spouse's benefit will be higher than anything yours could grow into by waiting. And because your spouse is older, they are more likely to pass before you. And when that happens, your benefit will go away. So let's say your spouse lives another 10 years. You would have collected a benefit over that time frame, supplementing their income. And now you'll have survivor benefit of about $3,700 a month the rest of your life. That move added an extra $700 of value monthly on your spouse's benefits by waiting for 3 more years before they collected. So what should you do with the benefits that you don't need? You should invest them. Let's say your portfolio covers all your spending needs and you don't even really need your Social Security benefit. You're receiving $1,800 a month from the government. If you invest that into a fund that earns 6% annually over the 10 years you collect before your spouse passes, that adds nearly $300,000 to your portfolio. This money can now be used to live on when the first spouse passes. It can be set aside for long-term care needs down the line, or continue to compound for your beneficiaries after you're gone. The idea here is that you control it, not the government. Whatever the reason is, this move added nearly $300,000 to your bottom line. The last reason talks about something that's punitive: the government taking away benefits because one spouse passes. Let's talk about using the rules the IRS put in place to your advantage now. The final reason is this: you might be able to take your Social Security completely tax-free. Social Security is taxed based on something called provisional income. And if that number stays low enough, your benefits aren't taxed at all. If it stays below $25,000 for single filers or $32,000 for married couples, your benefits aren't going to be taxed. If they drift above those numbers, then half your benefit becomes taxable, and ultimately 85% becomes taxable at the highest level. If most of your money is in Roth accounts or you can control your capital gains and interest, you can keep your provisional income number low. Let's assume someone needs $50,000 a year to live on after tax, and they're a single filer. Their Social Security benefits are $40,000. Let's assume all their other money is in a Roth IRA. Their provisional income in this instance is just $20,000, or half of their Social Security benefit. This is below the $25,000 threshold and means it's not taxable. They could then pull the remaining $10,000 from their Roth to live on and pay absolutely nothing in the way of federal taxes. If they had a brokerage account, they could realize $5,000 of capital gains or interest income as well before they would trip that provisional income limit. So in this case, taking Social Security early doesn't just give you income, it gives you tax-free income. So what's the takeaway from all of this? Delaying Social Security is not automatically the best strategy. It's just the most common advice. But as you've seen, the right decision depends on your situation, your health, your tax strategy, your portfolio, and your family dynamics. In some cases, waiting makes sense, but in others, taking it early can reduce risk, lower taxes, create flexibility, and even add hundreds of thousands of dollars to your net worth over time. The key is making a decision based on a plan, not a rule of thumb, or just some potential larger benefit that does not put more money in your pockets at the end of the day. If you're trying to figure out what makes the most sense for your situation, drop a comment below or reach out. There's a link in the description to get on my team's calendar. This is one of the biggest financial decisions you'll make in retirement, and getting it right matters. And if you found this helpful, make sure you subscribe for more strategies like this that actually move your needle. I'll see you in the next video.